Good afternoon, everyone, and welcome to this Nadex webinar, an introduction to Nadex knockouts and call spreads. My name is Todd Rich. I am with Nadex, and I'm going to be taking you through this session today. And with that, let's just get going because we've got a lot to cover. Before I jump into the presentation, and we're going to do more than just a presentation today, I do need to share this disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And lastly, this is an educational session. So I am doing this purely for your education. Please do not construe anything I say as a buy or sell recommendation. And that's important because we are going to be getting into a platform demonstration. We are going to look at these types of products and how they work and how you could leverage your opinion and use these products in the markets. So when we do that, I don't want you taking anything I say there as, ooh, Todd's telling me to buy or sell this. I won't be doing that. Okay. Now that we got that covered, I do want to point out a couple of things up front. I call them housekeeping items, but it's important. One, if you've got any questions, please email us, customerservice@nadex.com. Nadex is here to help you. We want you to be successful. And if you're having any challenges, whether it's around our products or your account, the platform, we're here to help, and we can't help it if you're struggling or have an issue and you don't let us know, we can't help you. So please let us help you. Two, if you had an opportunity and you can go to Trustpilot, and if you go to trustpilot.com and you put in nadex.com or you put in the site there, would love it if you gave us a review. It's something we're trying to build out here in the States. I'm also going to mention that you can follow us on our social media channels. I would highly encourage you to follow us on YouTube. The reason I specifically mention YouTube is we put a lot of content out there every day, every week. This session is being recorded, so you will be able to go back and review this at your leisure or share it with your friends if you like. You'll find it on our YouTube channel. It will also be available on our website in the webinars section of our website in the archive. And I'm going to put out one more thing to you because there's a slide deck here. If anyone would like a copy of this slide deck, if you would like a copy of this slide deck and you want to review it later, you have to email customerservice@nadex.com. So please interact with us. We want to help. And if you'd like the slide deck, as well as probably any of the slide decks from our webinars that are recorded up there, we can certainly accommodate that. You just need to ask. Okay, what are we going to cover today? And we have so many new folks with, oh, you know what? I'm also going to mention one other thing before I get into it. This is also an interactive session. All right, we've got quite a crowd here today. But if you've got any questions, you've got a little questions tab in there, type in your question. And I will try to get to it as we go. If I don't, I'll look back before we move between the slide deck and the practical application, the off-road session. I will look at the questions. The truth is if you've got a question, high likelihood that somebody else has a similar question. So please, type in your questions, and I definitely want to get to them if I can. And if I can't, I'll try to have somebody follow up with you afterwards. All right, hopefully that's fair enough. Now, as I was mentioning earlier, we have a lot of new folks. I mean, with the volatility that's been going on in the markets and people looking for access to price action, I do like to do a quick little 2-minute on who is Nadex. You're here, you're with Nadex. I'd like to just kind of go through who we are. And then we're going to talk about what you came to hear about today, which is specifically knockouts and call spreads. And I'm going to start with knockouts, and there's a reason why I do that. I think they're our most intuitive product. I think when I explain knockouts, people go, oh yeah, I get that. Of course I get that. Different than binary options and slightly different than call spreads, but I like to start with knockouts and how they work. And what is it you're getting into? And when you start trading a knockout, what's it going to cost you? How much can you make? How much could you potentially lose? How much money do I need to trade these? We're going to go through that with knockouts, and then call spreads will make total sense to you very quickly. Once you understand knockouts, call spreads are super easy to understand, but it's nice to start with knockouts. And then, as I like to say, my mom is from the great state of Missouri, the show me state. And I want to show you. We're going to do a practical demonstration. We're going to jump onto the Nadex platform. We're going to take a look at our knockout markets and our call spread markets, and you can see how you can access these markets and how you can leverage the tools that we've got at Nadex to trade knockouts and call spreads. All right, now, who is Nadex? I don't want to spend a lot of time with this, but I do think it's rather important. One, it stands for North American Derivatives Exchange. And what Nadex is, we are a properly CFTC regulated electronic exchange. Right now, our designations as a contract market and as a clearing organization are probably a little too much information, but the takeaway is we are regulated. We report into the same regulator that other larger futures exchanges report into. For instance, the Chicago Mercantile Exchange, the CME, or the Chicago Board of Trade, or the Intercontinental Exchange, who owns the New York Stock Exchange. They all report into the CFTC as well. Now, with call spreads and knockouts, it's nice to know that you're trading with a regulated marketplace. Probably our most popular product here at Nadex is binary options. And there are other binary option providers out there in the world. It's just that most of them, in fact, all but one other one, which is a small one here in the United States, are not regulated in the United States. And when you're dealing with an unregulated entity, buyer beware. I'm just going to leave it at that. So it's nice to know that you are dealing with a proper, true exchange in the United States that operates and adheres to all the regulations in the United States. Now, you can access Nadex markets from outside the United States. We have a list on our website of all the countries where you can access it, but it's nice to know that we have rules and laws that we have to adhere to. Now, what is it that Nadex offers is we designed our contracts specifically with the retail trader in mind, right? All of our products are geared specifically to retail traders. Now, what does that mean? It's a couple of things that I really like to point out. One, it's a low cost to enter the markets. All right, so you don't need thousands of dollars to get into to access price action in the markets. All right, it is a very low notional value contracts designed for retail traders, and more importantly, every contract at Nadex has clearly defined risk. There are no surprises. Things that you would hear about at all the other exchanges, like margin call, that's somebody else's problem. There is no margin call at Nadex. Everything, they're fully collateralized contracts. They're very small notional value. And so with defined risk, you know before you even get into a trade what you could potentially lose. You even know what you could potentially make. But they're small contracts so that retail traders can get in here and not have some crazy anomaly blow you up or wipe you out, because everything, all of the risk parameters are defined very clearly up front. And we offer a variety of products. We offer binary options, call spreads, and knockouts. And a lot of what people do in our markets, a lot of our traders, they're using technical analysis and they're looking for short-term price action. And that is what Nadex offers. You want that fast-paced, exciting Short-term price action, we have contracts like binary options that can be as short as 5 minutes. But then we've got contracts that are a couple hours, that go out for a day, and then we have contracts that go out for a week. But you're looking for short-term price action. You've got an opinion in the market. Let's put that opinion to test and trade, knowing that you've got defined risk, defined reward. Okay, so that's Nadex. Now I want to get into it. What are knockouts? All right, we're going to start with knockouts, then we'll go to call spreads, and then we're going to do the practical application. So first up, a knockout. A Nadex knockout, it's a contract, and it trades with a range. Okay, every knockout is going to give you a very clear range, and that range is going to have 2 price levels. Okay, and those price levels, one is called the floor, that is the lower price, and one is called the ceiling, that would be the higher price. All right, so pretty straightforward there. All right, you've got a range, it's got a lower price, it's got a higher price, a floor, and a ceiling. And the underlying market, now we've got knockouts in equity indices, foreign exchange pairs, commodities like oil, gold, natural gas, silver, right? So we've got these contracts, and the value of the contract, and let's just pick the NASDAQ, for instance, because the NASDAQ was moving around a bit today. If you were trading the NASDAQ 100, that contract is going to trade in a range, and it's going to move right in line with the underlying market. So if you're trading the NASDAQ's right around 13,500-ish, okay, ballpark. The price of the knockout is going to trade right in line with the value of that NASDAQ future. It's what we call a Delta 1 product. When you're buying or selling a knockout, you are trading the price of the underlying market. Okay, and it's going to move right in line with the underlying market. This is only true of knockouts. So the way it works, it's the same as pretty much any other market that you trade, that you really are familiar with. If you think it's going to be up, you simply buy, and if you think it's going to go down, you can sell. Now that sounds a little weird when you say, what if I don't own it? How can I sell it? But the way it works with knockouts, you're trading the price of the underlying. If I thought the NASDAQ were going to go higher, I could buy it at 13,500. And if it went up, I could potentially I would profit. If it went down, I would lose. Now, I can, without owning it, I can still take a bearish or negative view on the NASDAQ. If I thought the NASDAQ index were going to go lower, I could simply sell a knockout. And you would have a short position in the knockout, right? And if the NASDAQ index were to go lower, and you sold one, you would profit. If it went higher, you would lose. So that's a knockout. You're trading the price of the underlying market, and you can go long or you can go short. Now, a knockout, it is a contract, all right? It is a contract, and the contract is set to expire in one of 2 ways. So all of our knockout contracts initially start off as week-long contracts. So every Sunday night, we will launch knockouts for each one of our products, and it'll be set to expire at the end of the week, but it can expire before then. So let's first go through the price trigger settlement. All right, and so what happens is you've got a knockout, you're trading that knockout, it's got a floor and a ceiling, and if the indicative index for that market were to touch the ceiling or touch the floor, the contract settles. Right then, it's over, and we'll launch a new knockout. But that particular knockout will settle. So if you bought the NASDAQ knockout and it went down, so it went against you, and it touched the floor, you would get knocked out of your trade. That's why it's called a knockout. And you would get knocked out there. You would get knocked out for maximum potential loss. You bought it, it went down, and you got knocked out. It essentially stopped you out. If you bought it and it went and touched the ceiling, you would again get knocked out of the trade. There, you would get knocked out for maximum potential profit. So that's why it's called a knockout. Okay, so you're buying or selling the actual price of the underlying market, and you've got this floor and the ceiling, and if it touches the floor or ceiling, you would get knocked out of your trade and you would experience maximum potential profit or maximum potential loss. Now, what happens if it doesn't touch the floor or the ceiling? And that's where we've got the time triggered settlement. All right. And this is where if we start a contract at the beginning of the week and it doesn't touch the floor or ceiling at all, it will settle at the end of the week. Now, the truth of the matter is that generally doesn't happen over the course of the week. What'll happen, and we'll go through some examples, is the knockouts will get knocked out one way or the other, and then we just simply launch a new one. It will also expire at the end of the week, but let's say it's Tuesday, there'll only be 4 days left, 3 days left in the contract, not 5. And you'll see how that works. But at the end of the week, all those knockouts will settle. Okay, and it'll settle if it hasn't been knocked out, it will settle at a price between the floor and the ceiling. So if you buy or sell a knockout and it doesn't touch either the top or the bottom, it doesn't hit the ceiling or the floor, at the end of the week, it will settle. And what'll happen is, or let's go through this. I don't want to jump ahead of myself. As I mentioned, each knockout has got a maximum duration of a week. At the beginning of the week, we do launch 4 knockouts for each market. So you've got a variety of choices to choose from. And I'll show you how we determine what markets that we want to put up, so that you make sure that you've got a range, a variety of choices. And then if one is knocked out, all right, and it expires, we will launch a new one. So in general, you'll almost always see 4 unique knockouts for each market. Okay. Now I do want to run through. I'm going to run through an example here, and you'll actually see how we list knockouts and how that plays out over the course of a week. And this is an S&P 500 example. Okay, and it doesn't matter the price. It doesn't matter. I mean, we're not exactly here at the S&P, but this is all just an example. The S&P 500, it starts and it's at 2720. Okay, and we will at the beginning of the week list 4 knockouts. Now, the way that we do it is we initially, we'll call it knockout 1, is we'll take the current price and go down 10 points. That would be the floor. And we'll go up 40 points. That would be the ceiling. So the knockouts in the S&P have a range of 50 points. These knockouts, the largest notional value for a knockout for the S&P 500 is $500. All right, and you'll see that because it's 50 points wide, and I'll go through that in a second. We'll then create a knockout that's got a slightly lower floor and a slightly lower ceiling, and then we'll continue until we've got 4 knockouts. And you can see that where we're starting, knockout 1, it starts and it's close to the floor, and knockout 4, it's closer to the ceiling, and you've got a variety of choices in between. Now let's go through what happens over the course of a week when the price of the S&P moves. All right, and by the way, there's the end of the week. So you know that there is an end at it, and that's the time triggered settlement. All right, so we skip forward, and you can see we started off, and the price of the S&P started to drift higher. And as it went higher, notice that it touched the ceiling of knockout number 4. Okay, so it went higher, and I told you, the knockout number 4 we know had the lowest ceiling. When that happened, boom, knockout number 4 got knocked out. All right, if anyone who bought it, and if they happen to buy it there, and it went up a little bit, and if you bought this one, I don't know why you would buy this one. We'll go into that in a bit, but you would have been knocked out for profit. More likely, it's someone who sold it, they thought the S&P were going to go lower. They were wrong, and they got knocked out because it went up. You know, they were looking to profit if it went down, and they were wrong, but they got knocked out. And we add, because it went higher, we add a new knockout with a higher range so that we can now accommodate that the 4 variety of choices. All right, now I'm going to go through another example. Instead of it going up, it went down. All right, now you'll notice that, well, knockout number 1, it hit the floor. All right, boom, knockout number 1 got knocked out. All right, and it settled, and we simply add another one to the downside. All right, so as the week goes on, you'll see knockouts, whether the floor or the ceiling gets hit, they'll get knocked out, and we'll add another one. All right, and as the week goes on, the range of choices that you've got for knockouts will change and will fluctuate based upon the price of the underlying. Now let's take a look at time triggered settlement. All right, so now you know that you're really taking a delta 1 directional play. You buy a knockout if you think the price is going higher. You sell a knockout if you think the price is going lower, and you've got these very clear, distinct levels where you would get knocked out for either a profit or a loss. All right, if one of the floor or the ceiling is touched. Now, let's talk about time triggered. All right, it goes, and it's knockouts sometimes are considered variable payouts, because in the end, all right, if it doesn't touch the floor or the ceiling, all right, the profit or loss that you'll have will be the difference between where you bought it or sold it and where it settles. So if I buy a knockout and it doesn't touch the floor or ceiling, and let's just go through an example, and here's an example of what that would look like. So here we are at the end of the week, and this is that same S&P 500 example I've been using earlier. We've just now, and you can see that the knockouts have all probably changed, and these are the last knockouts we've got. If you look at knockout number 4, if you bought or sold knockout number 4 in that range, you probably didn't have much of a profit or a loss, because it hasn't gone up or down. But at the end of the week, it will settle, and the profit or loss that you experience will be the difference between where you bought and sold it and where it settles at the end of the week. So, I mean, that's just it. So if you sold one and it settles slightly lower, you're going to have a partial. If you sold one and it settles slightly lower, you're going to have a partial profit. You won't experience maximum profit because it didn't get down to the floor, but you'll have a partial profit, the difference between where you sold it and where it settled. If you sell one and it goes up, it goes against you, but it doesn't touch the ceiling, so you're not knocked out. It just goes up a little bit and it settles on a time trigger. You're going to have a partial loss. You won't experience maximum loss because it didn't go up and hit the ceiling, right? Because you sold it, but you'll have some type of partial loss. Hopefully that makes any sense. If anyone's got any questions, please feel free to type them in. Now I want to go through what it is. And as I mentioned, these are all contracts that are built for the retail trader. The notional value are binary options. The notional value for all of those is only $100. It's pretty straightforward. For our knockouts, on the other hand, Most of them are $500 contracts. I think the Nasdaq is a $600 contract, but as you'll see, you don't need $500 or $600 to trade these. You're going to need some fraction thereof, depending upon where you buy or sell. Now, as I mentioned, all of Nadex products have defined risk, defined reward. You know exactly what you could potentially make or exactly what you could potentially lose before you even get into the trade. We will do that calculation for you. And really what you're doing when you're trading a knockout is it's almost like having a trading plan baked into your trade. All right, it's I don't want to say it's training wheels. I want to call it more. You know what it is? It's guardrails. It's guardrails for people who have a difficult time trying to establish. All right, when will I take my losses and when would I take my profits? Here, it's built into the nature of the knockout. All right, you're going to have natural profit targets and you're going to have natural stop loss targets. Simply around due to the structure of the contract, it's built in with that floor and ceiling. So if you buy one, you've got a profit target. Your target would be if it hits the ceiling, if you buy one. If you sell one, your profit target would be, hey, if it hits the floor. So you've got one, and at either one of those situations, you would get knocked out for maximum potential profit. Thank you very much. Move on to your next trade. They've also got a predefined stop loss level. If I buy one and it goes down and touches the floor, I'm knocked out. It forces you out of the trade and forces you to go, I have to reconsider. My opinion was wrong. All right, I didn't analyze this, or it doesn't. Not every trade's going to go your way. Or if I sold it, all right, I think it's going down, but it went up and it touches the ceiling. It's going to force you to take those losses. All right, now, in regards to the risk of trading knockouts, it's actually pretty intuitive. All right, if I buy a knockout, my maximum risk is it went down to the floor. If I sell one, my maximum risk is it goes to the ceiling. On the reward side, it's exactly the opposite. If I buy one, my maximum potential profit, my maximum reward is it goes all the way up to the ceiling. And if I sell one, my maximum reward is it goes all the way down to the floor. And in any one of those situations, you are knocked out of the trade and you experience maximum potential profit or maximum potential loss. Okay. Now, I actually, I want to do this. And by the way, it looks like we're going to go through this again, but I kind of like the visualization so you can see a little bit more clearly with nice, pretty colors, the risk reward. And then it'll also make it a little bit more clear why we have 4 different choices and why we want you to have 4 different choices. All right, so here's that same example from earlier where we've got knockout number 1, okay? And let's just assume that we buy knockout number 1. And notice the way that people generally like to look at these is if I'm going to buy, I would probably choose knockout number 1 or maybe knockout number 2. That is because if I buy it, I'm closer to my floor. I'm keeping my stop losses tight. Knockout number 1, it's very close. Knockout number 2, it's just a little further away. If I were looking to sell, I thought something were going to go down, I'd probably choose knockout number 4 or knockout number 3. Knockout number 4, again, if I sold, it's a tight loss if it were to go up. If I wanted a little extra room, I might choose knockout number 3. All right, and that should make sense. Is you want to keep your losses a little tighter and your potential profits a little higher because you need to know, hey, if I'm wrong, I've made a mistake, get me out before I really get hurt. And that is why we offer these 4 choices. Now, to visually see this, here's that same example, knockout number 1, and I'm buying knockout number 1. Here we are when I'm buying it, the left, the the black line to the left. I've got the end of the week at the right, and I know I've got this floor. All right, I've got this floor down at 27.10. If I buy it, I know it's got that ceiling up at 27.60 above. And I see that it's a 50-point range. I know that it's a 50-point range. I'm in the S&P 500. And if I look and I draw a flat line across, all right, I'm buying at 27.20. The most I could lose is if it goes down and touches the floor. It's very easy to see that red zone at the bottom is where I lose, and the green zone up above is where I would profit. This is assuming I buy one. Now, the reason that we offer 4 different choices is that ratio between how much risk I'm willing to take between the red and the green. You've got a variety of choices. There are 4 knockouts where the balance between the risk and reward is somewhere some variation of this. Now, this is me buying. If I were to sell, it would be the exact opposite. All right. So if I were to sell one, and here I'm looking at knockout number 4, as I mentioned, you would generally choose one where the ceiling is closer to where you are because you're selling, you're looking for it to go down. But if you're wrong, it's the exact opposite. All right. I've got that ceiling up at 27.30. I've got my floor down at 26.80. And if I sell, I've got a little bit of risk if it were to go up and I were wrong, but the green area is where I would profit. And again, you can see now between buying and selling and 4 different knockouts, there are a variety of ratios between the amount of risk you're willing to take and the amount of reward that you're looking for so that you can pick the knockout and the direction that suits your risk reward profile. Okay, so hopefully that was pretty clear. I think knockouts are pretty intuitive because they're Delta One, and it's simply I buy it. I buy it because I think it's going up, and if it does, I make money. If it goes down, I lose money. If I hit one of my boundaries, I'm knocked out for maximum potential loss or maximum potential profit. And if it doesn't, and it settles at the end of the week, and time runs out, the profit or loss that I would experience would be the difference between where I bought it or sold it and where it ultimately settled. Okay, pretty straightforward. It's kind of like what everything else that you would do. Now, to trade these, like I mentioned, there is no margin call. There is no margin call. There is never a margin call at Nadex because you know what your maximum risk is before you place a trade. What you have to put up to trade a knockout is simply the most that you could lose. So, for instance, on an S&P 500 contract, you know it's a 500-point range, and if you were to choose one that's exactly and trade one that's exactly 10 points above the floor, and your maximum loss is 100, and your maximum profit's 400. You would have to put up the 100, the maximum you could potentially lose. If you bought it and it was 20 points above, all right, so you've got $200 of risk to the downside and $300 of potential profit to the upside, you'd have to put up the 200 that you could potentially lose. And that's just it. And that's it. You put up how much you could potentially lose, and you go from there. All right, that is your maximum. So the amount of money that you would need to trade a knockout is simply the amount of risk you're willing to take, and that's what you have to put up in order to trade a knockout. That will not change, and it doesn't matter whether you're buying or selling a knockout. Once you put on the trade and on the order ticket, we show you what your maximum potential profit and maximum potential loss are. Once you put on a trade, that is what you would have to put up as collateral, is the most that you could potentially lose on that trade. And it's always a known commodity, and that is exactly why we put out multiple knockouts. That's why we give you 4 choices. You can determine how much risk, how much reward, and you can then design your trade around how much capital you have to trade with, and you can minimize your risk by trading by taking a position where the risk is the lowest, and that would minimize the amount of capital that you would need in order to put on the trade. All right, that is why we give you those choices, and that is why you would have to make a determination. What do I think is going to happen? What is my opinion on what's going to happen in the market? How much risk and how much money am I prepared to have to put up? Because that's what my capital requirement's going to be. Then you can find the knockout that suits your trade. Okay, now just quickly on an order ticket, I do like this. One, you're always going to see the range at the top of the order ticket. All right, the S&P 500, it's a 50-point range, so 36.62 to 37.12. There's going to be a bid-ask spread. Okay, that is the bid is where you can sell, the left-hand side. The offer is where you could buy, but interestingly enough, you do not have to buy or sell on those prices. We have a central limit order book. Anyone can post an order into the market. Anyone can post liquidity, meaning if I wanted to potentially buy one, I can try to buy one in between that bid-ask spread. And I will show that to you. If I want to buy this S&P 500 contract, I don't have to pay $36.75. In fact, in this example, you can see I might try to buy it in between. What if I tried to buy it at 36.74.50? All right, it's in between the bid-ask spread. Now, does that mean I will buy it there? Not necessarily. Someone has to sell it to me. I know that if I absolutely wanted to buy one right at the second, I could pay 36.75.10. I could buy one right away, but I don't have to. If I want to try to get a slightly better price, I'm allowed. I could put my bid and maybe someone will trade with me. So you can put a bid or an offer in between the bid-ask spread. Now, if I were to try to buy one at 36.74.50, it actually tells me right down there, okay, if we went down to the floor and it went down to 36.62, you would stand to lose $125. That's going to be your capital requirement. That's what it would take to put on this trade is $125. That's the most that you could potentially lose. If you bought one at 36.74.50 and it went down against you and touched 36.62, you would get knocked out for maximum loss of $125. Now you do have your profit goal, 37.12 up above, where you could potentially make $375. If you bought this and it went up and it touched that, that's what you would potentially make. Also, if you look in the upper left-hand corner, right at the top of the ticket, there's an indicative price, 36.74.86. Now, notice that that price is in between the bid-ask spread. All right, this is why I think these are so intuitive. You are trading right around the current indicative price. The price that you see and the price that you could potentially buy or sell are going to be right there hovered together. All right, pretty intuitive. That's what I think. If you think it's going up, you buy. If you think it's going down, you sell. And you've got distinct knockout levels one way or the other. All right, and it looks like I have, excuse me, I managed to answer all the questions I've gotten so far, just in the nature of it. But please, if you got any more, go ahead and kick them in. So hopefully that the knockouts all made sense. Now, call spreads. The reason I do call spreads second is because call spreads are actually very, very, very similar to knockouts. Okay, a call spread is also a contract with a predefined range, and that also has a floor and a ceiling. All right, sounds identical, as a matter of fact. And the value of the contract, though, is going to move in line with the underlying, but only similar, not identical to knockouts. And why is that? And there are two distinct ways that call spreads are different from knockouts. They're going to look and behave similarly, but call spreads, Number one, and this is the reason why, a call spread only expires at expiration. There is no price triggered settlement. So when you trade a call spread, all right, and it's going to have that range, let's say you buy a call spread and it goes down and it hits the floor, you will not be knocked out of the trade. All right, so with a call spread, you've actually got time to potentially be right. So if you buy a call spread, you have very defined risk. We will calculate for you what you could potentially lose on this trade. And if you buy one and it goes down, you know upfront what you could potentially lose. Now, if it touches the floor, you are not knocked out. All right. It could eventually go back higher and you could potentially profit. Now, that also means that if you bought one and it went up to the ceiling, all right, and went through the ceiling, you would not get knocked out there either for a profit, which means if you bought one and it went up to the ceiling and then came back down, you could potentially still lose on the trade. You aren't knocked out for a loss, but you're also not knocked out for a profit. A call spread will only settle at expiration, period. All right. Now, because of that, it's got optionality. Okay. A call spread has optionality. And due to that, the price that you actually are trading is not, in all likelihood, going to be identical to the underlying. There is going to be a premium baked in to the price of a call spread when you buy or sell it. And I will show that to you on the platform, but you can see if you're buying a call spread, you're probably going to have to pay higher than the current market price. And if you're selling a call spread, you're going to have to sell it at a price lower than the current indicative price. And that is because there is going to be volatility and time to expiration baked into the price of a call spread. Right? If something is swinging all over the place and there's volatility and it's going up and down, it's going to impact the amount of premium in that contract. Also, if it's very early in a call spread and there's a lot of time for something to happen, that's also going to impact the premium in the call spread. If there's very, very little time, so actually if you were if there was volatility was low, down near zero, and you were at the end, maybe there's only an hour or two left in a call spread. So you have a call spread with no volatility and only an hour or two to go until expiration. Then it would look very, very similar to a knockout. There would be pretty much no premium in it and it'll trade right in line with the underlying. But until then, if there's high volatility and a lot of time to expiration, there is going to be a premium factor because a call spread has that optionality. So that is the difference between call spreads and knockouts. And you've got to decide, do I want to have, or do you want to have rigid parameters that simply knock you out of your trade? And it works both for and against you. If you are in a knockout and you get knocked out for a loss, you go, why didn't I have a call spread? Because it came back. Now on the flip side, if it goes your way, you trade, you buy or sell something, you buy one and it goes through the ceiling, and a knockout, you're knocked out. You got maximum potential profit, and then it came all the way back down. You're like, woohoo! Thank gosh, the knockout made me take maximum potential profit. On a call spread, it might go up through there. You weren't paying attention. It came right back down, and you missed your opportunity to get out for a profit. So you have to decide what suits you better. Do you want to have those hard defined rigid parameters where it simply takes care of it for you, maybe because you can't be looking at it all the time? Or do you want to have that optionality so that you don't get knocked out and it doesn't, you don't get, it goes against you immediately and then goes right in your favor and you go, shoot, I could have done better. So you've got to decide the risk reward that you're willing to take can you monitor these, and what is it you're looking for, but subtle differences, but distinct differences between knockouts and call spreads. Now, something I have not mentioned, and if you take nothing else away from today's session, nothing else today, this is the one important rule I want you to take away, and this is true for not just knockouts and call spreads, but for binary options. So I'm flashing red alert, red alert, red alert. Pay attention. This is absolutely critical. When you're trading knockouts and call spreads, just because there's an expiration associated with the contract does not mean you have to wait until expiration to see what happens. Now, with a knockout, right, it's going to touch a floor or ceiling, you'll get knocked out, and then there's a time settlement. But you do not have to wait for it to touch a floor or ceiling, or for it to go all the way to the end of the week. And a call spread, you do not have to wait for it to go all the way to the end of the week. Just because there's an expiration associated with the contract or knockout levels associated with the contract does not mean you have to wait until then. You can choose to exit your position early. And I'm going to say that again. You can choose to exit your position early. So why would you exit a position early? There's two reasons why you would exit a position early. Either to lock in profits or to minimize losses. So yes, a knockout does have predefined profit and loss targets, but those don't have to be your targets. If you buy a knockout and it starts going down and you go, you know what, I don't like this. I don't have to wait for it to touch the floor and for me to get knocked out and take maximum loss. I could just simply reverse my position. If I bought it, I can just sell it, get out and take a partial loss and move on. Conversely, and probably more to the case, because if you bought one, you probably are okay with the risk you took to the downside. If it goes up, you do not have to wait for it to go to the ceiling or for time to, you can say, all right, listen, I risked $100 on this knockout. I bought one. I knew if it went down 10 points, I was going to lose $100. It's gone up 10 points. I've made $100. Maybe it's gone up 15 points. I made $150. I can then choose to simply sell it, take my profit, and reassess. So you don't have to wait until expiration. You are allowed to take profits off the table early, or you're allowed to limit your losses and take partial losses early if you want to. All right. The knockout range is there it will force you to get in or out for a maximum potential loss, but you can always choose to trade out before then. And same goes for a call spread. In fact, even more so for a call spread, because when you buy a call spread, you know exactly the most that you can make. And if it goes up and it goes through that ceiling, you're going to be near maximum potential profit. There's probably nothing more for you to make. The only thing could potentially happen is it turns around and goes against you. You probably would want to sell out of it, take your profits, and move on. Or if you sold a call spread and it went down through the floor, you might just want to buy it back and take your profits and move on. So you don't have to wait until expiration. You can choose to get out early. Okay? I can't emphasize that enough. All right, now, customer service at nadex.com. Please email us if you have any questions. And for that matter, if you want the slide deck, please email them, ask for the slide deck. They will send it to you. All right, now I'm going to go to the practical application. I am going to now switch screens. And again, if you've got any questions or you'd like to see anything when I do a demonstration, if there's a particular product you'd like me to do the demonstration in, by all means, shoot it into your questions. I don't mind doing that because I don't care what product we're going to demonstrate. So if anyone wants to type one in, by all means, feel free to do so. All right, I am going to, let's do this. Okay. I wonder if good. Look at that. That works. You know what? I just wanted to show this to you also. And the reason I want to point you to this is the Nadex YouTube channel. Okay, and I would highly recommend that you go here and you subscribe to our channel. Every day we've got content. The recording for this session will be posted up here. But if you're not familiar, in this videos section, I'm looking at videos. You can see we do one every morning. We do two every morning. My colleague Travis McGee does a very early morning, quick little 1 minute. Hey, what happened overnight? But then I do a session with one of our educators where we do a 15-20 minute session. We do technical analysis. We look at hot spots in the market that you might be interested, you might want to look at today, which we do that live stream. And in fact, if you take a look, and just to see where I am, if you're on the video section and I were to change this from uploads to upcoming live streams, you'll see that we've got live streams and you could set a reminder and say, ooh, remind me. We do those at 9 a.m. Eastern, 8 a.m. Central every single day. Every single day, we do a 15-20 minute session. And if you wanted to look at some past live streams and you wanted to go back and see what we did, you can clearly see, I mean, we've got people tracking us. Again, quick 15-20 minutes. So if you miss it in the morning, you can always come here and catch it and replay it at your leisure. Today, I know that we talked about the NASDAQ index. We talked about crude oil. And I missed the inventory report, so I don't know what crude oil did today. That could be an interesting one for us to look at. We talked about the US dollar. So again, follow us on YouTube, come to the channel. You can set reminders. Every single morning we do a quick session. All right, now I'm going to jump back over to the Nadex platform. Okay, and we are going to look at, and I'm looking quickly for the questions that came in. If you give me 1 second. Okay. And all right, there we go. All right, so let's go ahead and take a look at, all right, we've got, if you've, let's just do this for a second. All right, I'm gonna go back. All right, we've got binary options, call spreads, and knockouts on our platform. I am going to go ahead and start with knockouts. And I'm going to, you can see that we've got knockouts in indices products, foreign exchange, and commodities. I'm going to go ahead and jump into commodities. And I mentioned crude oil. I would love to see what it did today. Didn't look like it had, it went down. It didn't have too much of an impact. Notice when I open it up, I've got 4 different knockouts. Okay. I'm just going to click on any one of them. All right. And I'm going to now move this aside. And let's take a look at what crude oil. I'm going to go ahead and make this a 1 hour so we can have a little bit more. There we go. And shrink it down some. All right, perfect. Okay. Well, let's do, okay, now you'll notice 4 knockouts. When I'm looking at the chart, we've got 4 vertical lines on the left-hand side of the chart. Those are our 4 knockout ranges. I happen to like that. So you can choose and you can quickly and easily see where the floor and the ceiling for each knockout is. If I thought crude oil were going to go higher, all right, and here we are, and you can see on the chart where crude oil currently is, 60.75. It's here on my indicative price, 60.75. Notice that the prices that for this knockout, right around 60.75. I mean, it's right there, okay? If I thought it were going to go higher, this might be one that I would want to choose. I would click buy. All right. Now, if I wanted to buy one, do I have to pay the offer? No. Let's just say I want to pay 60.75. I want to join the bid. All right. All right. I'm willing to pay 60.75. If I were to try to buy one here, now if I put a bid in, does it mean I'm going to buy it there? Not necessarily. Someone would have to sell it to me. But if I bought it there, I know that the most I could lose would be $75. If it went down and it touched the 60 floor. All right, and this has got 1 day and 1 hour to go for this knockout. It's a weekly contract and this one's got a day to go. If it went all the way up and it hit the ceiling of $65 a barrel, I could potentially make $425. Now, 60.75 is between the bid-ask spread. I'm actually going to middle the market. I'm going to go ahead and place the order, and you can see. Now, again, notice I'm in a demo. This is not a buy or sell recommendation. This is the demo environment. If you don't have a demo, I'd highly encourage you to open one and you can practice trading. Now, I put a bid in there. You can see that there's one that's bid for in demo. That's me. I'm going to bring this up and I'm going to look. I've got an order. I am trying to buy one at 60.75. If I buy it, I could potentially lose $75. I could potentially make 425. Let's go ahead and buy one. Let's just change my order. Oh, you know what? I was just about to buy it. I was going to pay up. Notice what happened. It disappeared out of my orders. What happened? I'm looking at my positions pane. Somebody sold it to me. Okay. Oh, and it went lower. All right. So I bought one. I just wanted to show you that I could do that. Now, if it goes down, I know that my risk, I was willing to take $75 of risk. It's currently going against me. Now, do I have to wait for it to go down to 60 and for me to get knocked out and lose my $75? No. If it kept going lower, I could say, I want to dump it and I could simply sell it and get out of my trade for a partial loss. Now, do I have to wait for it to go all the way up to $65 to get knocked out up there? No. Let's just say I would be happy if it went back to 62. Okay. If it went up to 62, I would sell it at 62. I can place an order above the market. Okay. I can place an order above. All right. Now, all that would be doing is I'm long one. By placing an order to sell one higher, that would just liquidate me out of this position. Now, am I going to sell it up there? I don't know. But you can see that I now in my order section have an order to sell one up above all the way. If it gets up to 62, if it goes up $1.25 a barrel, I'll go ahead and get knocked out. So you don't have to trade on the bid and on the ask. I could choose to try to trade in between, and I can place an order away from the market, and or I can just let the knockout do what it does. Which I know that on my risk to the downside, if I goes down, I would get knocked out. But here I was speculating that it was going to go higher, so I bought it. All right, and it's just as straightforward as that. If I think it's going up, I buy. If I think it's going down, I sell. All right. Now I'm going to take a quick peek at these questions. I think we're okay. All right, excellent. Now, I want to show you, hopefully that was clear. If anyone has any questions about how the knockouts work, and you can go through and you can cycle through all the different products. If you want to trade foreign exchange, we've got a variety of foreign exchange pairs, but everything's going to work the same way. All right, you just simply click on any one of the knockouts. I'm going to make the chart bigger here, and let's shrink this down. Here's the Aussie yen, and you're always going to see the 4 levels, the 4 different knockouts with your floor and your ceiling, and you can make a determination what is it that you think is going to happen. And I can, if I want to, if I think it's going up, I go long. If I think it's going down, I sell. And we calculate your potential maximum risk, maximum reward. Now, notice here, for instance, the Aussie yen, these contracts only have a total notional value of $200. All right, so each knockout will have, you'll see what your potential maximum profit and maximum potential loss, and the ranges will be different depending upon which product you choose, whether you're choosing indices, foreign exchange, or commodities. All right. As I mentioned, for instance, let's just take a look at the Nasdaq, because I used it as an example earlier. Boy, the Nasdaq's really been all over the place, hasn't it? I take a look at one of these. Let's just choose this one. Here, the total is 600. All right, if so again, you'll have to look at the range and the notional value for each contract, but I think you get the idea. All right, perfect. Any other questions on that? I think we're okay. I think I got them all. Let's go to call spreads. All right, now call spreads, very, very similar to knockouts. All right, and I'm just going to do this quickly. Let's just choose crude oil. All right, because let's just go ahead and Let's move this aside. Now the chart's going to look slightly different for crude oil. You know what? I think I'm going to try. This will be easier. Okay. There we go. All right, I'm going to choose these dailies. The way it works for call spreads, you're going to see a range in blue. You're going to see a range where the contract is trading. All right, it'll actually be, if I'm clicking buy, it'll be blue. If I'm clicking red, I want it to go down, it would be sell, it would be red. If I click the buy side, it's blue. If I click the sell side, it's red. And it just simply gives you the range, and you got the floor and the ceiling. All right, and again, whether you're selling it or you're buying it, all right, we give you exactly what you could potentially make and what you could potentially lose when you're trading. Now, if you'll notice, when I'm choosing in the middle of a range, it's similar, it's close. The indicative price and the price that I would buy or sell is actually kind of close to the underlying. It's when I get to the edges, and what it is too. All right, so let's click, there we go. Where the price is going to be different. So if I, if I were to buy this with the 6150, now notice this has only got an hour and a half to go. This has only got an hour and a half to go. So, here's a call spread to the upside if I thought it were going lower, if I thought it going higher. If I thought it were going lower, I might sell this one below. I mean, we've got, multiple choices of call spreads. And again, the way you can tell is by clicking on each one of these, you'll see a different shaded area for each one, right? As I click through. And it shows you which the shade area, and then it tells you, if, and that actually helps you if you're buying or you're selling. But again, if I thought oil were going to go lower, which one would I want to sell? I could sell this one, all right? Now, where, again, it's all a matter of how much are you willing to risk and how much are you looking to potentially gain, realizing there's only an hour and a half to go. And again, if I sold it, and it were to go lower, I can always try to buy it back for a lower price. I don't have to wait the 1 hour and 25 minutes. And again, volatility and time to expiration on call spreads will be factored into the prices where you're buying and where you're selling, all right, versus a knockout, which is always a Delta 1 product. All right, I did go a few minutes over. I'd like to be cognizant of everyone's time. I want to thank you for joining me today. I want to remind you again that this was recorded, that if you would like the slide deck, by all means, please email customerservice@nadex.com and we can get you a copy of the slide deck. The recording will be available on our YouTube channel as well as on our website. If you go to our website in the webinar section, you can also find any upcoming webinars, and I'm also going to tease up, we're doing another full day education event, another day trading boot camp that's going to be coming up in March. So keep your eyes open for that and join us every morning. Please come to us YouTube live on the Nadex channel for 15 minutes every morning, where we do some live analysis of potential hotspots in the markets for the day. And with that, want to wish everyone good luck in the markets. Thanks for joining us, and hopefully we'll catch you at one of our other sessions.